Silver just got destroyed. Look at this chart. Silver opened today at $96. Right at the open, it started selling off, dropped all the way to 92. Then it recovered, fought its way back to 96. And just when it looked like the selling was done, just when people thought the worst was over, it got hit with a sudden $10 crash. 96 to 86, over 10%. Gone. In one move, while a war is raging in the Middle East, while missiles are flying, while the Strait of Hormuz is being choked. A $10 crash out of nowhere after it had already recovered from the first sell-off. That is the kind of move that shakes people out of positions. I need to walk you through exactly what happened, exactly why it happened. And then I am going to tell you the honest truth about what I am watching right now to figure out if this is the buying opportunity of the decade or the start of something worse. Stay with me on this one, because I am going to show you data today that changes how you look at this entire move. But first, I need to address something, because I know exactly what some of you are thinking right now. In my last video, I told you 5,400 was the last line in the sand for gold. I told you that was the level. I told you that if gold gets to 5,400, it either breaks through and we're off to the races, or it gets rejected hard. And this morning, gold gapped up at the open. It jumped straight from 5,278 to 5,400. No trading in between, just a void. It touched 5,418, and then it got hammered. Gold came all the way back down to 5,265. The resistance at 5,400 held. It rejected. And I called that level before it happened. That part I got right. What I did not tell you, and what I need to be honest about, is how violent that rejection would be and what it would do to silver. So, let me break the whole thing down for you. Gold gaps up at the open, 5,278 to 5,400. Over a $100 gap in the blink of an eye. That tells you something massive. That tells you the weekend risk from the war, the Fata 2 missile footage, the Abraham Lincoln getting targeted, the embassy in Pakistan, all of it. The market priced in a $100+ gap. That is how scared money was over the weekend. Over $100 of fear in one opening print. Now, when gold gaps up like that directly into a major resistance level, one of two things happens. Either the momentum blasts through and the sellers get steamrolled and gold never looks back. Or the sellers are waiting right at the level with everything they have and they slam it back down. Today it was option 2. Gold touched 5,418, and within hours it was back at 5,265. That gap got filled fast, and it got filled ugly. Now here's the question that matters. What does a rejection at 5,400 actually mean? Because there are two ways to read it, and most people are reading it wrong. The wrong way to read it is that gold failed, that the rally is over, that 5,400 is some kind of ceiling that gold cannot break. That is the read you are seeing all over social media right now, and it is lazy. Here is the correct way to read it. Gold was at 5,230 on Friday. It is at 5,300 right now. It went on a $150 round trip and ended up $70 higher than where it started. It did not collapse. It did not break down. It went to the wall, tested it, got pushed back to 5,265 at the low, and has already recovered back to 5,300. That is not failure. That is a first attempt. And first attempts at major resistance levels almost always get rejected. What matters is what happens next. Does gold come back and test 5,400 again within days? Because in my experience, when a gap up tests a level and gets rejected, but the price does not fall apart, the second test usually breaks through. The demand that caused that $100 gap did not disappear. It is still there. It is reloading. The people who bought the gap are underwater right now, but they are not selling because the reason they bought, the war, has not changed. And the sellers who defended 5,400 just used up a huge amount of ammunition to hold that level. They are weaker now, not stronger. But I want to talk about silver because that is where the real damage happened today, and that is what most of you are feeling right now. Welcome to the hidden economy. If you're new here, hit subscribe right now and hit the hype button. Comment which country are you from, and now let's get into it. Before I get into silver, let me explain something about gap ups and rejections that I have learned over years of watching this market. When gold gaps up over $100 into a resistance level, it does two things at once. It tells you the demand is enormous. Nobody gaps a market over $100 unless there is genuine panic buying. But it also tells you the move happened too fast for the market to build support underneath it. There was no consolidation, no base building, no volume at the prices in between. Gold went from 5,278 to 5,400 with nothing in between. That means if the level rejects, there's no floor underneath. No buyers sitting at 5,300 who are going to catch it. It just falls back through the void until it finds the last level where actual trading happened. That is exactly what you saw today. Gold gapped up, got rejected, and fell straight back through the gap to 5,265 where the trading volume was. That is a gap fill. And gap fills after first tests of resistance are completely normal. They look terrifying on a chart, but they are actually the healthiest thing that can happen, because now the market has to build support the hard way, by actually trading at these levels, by building a base, by letting buyers accumulate positions. And when that base is built, the second test of 5,400 will have a foundation underneath it. The first test was a raid. The second test will be a siege, and sieges work. Silver dropped from 96 to 86, $10, over 10%. In the same session where gold dropped about 3%. And I need you to understand why. Because this is the single most important lesson you can learn about the silver market. And it will save you from panicking out of a position at the worst possible time. Silver is a leveraged play on gold. It always has been. When gold goes up 5%, silver goes up 10 or 15. That is the part everyone loves. The part nobody likes to hear is the other side. When gold drops 3%, silver drops 7, 8, 10. It is the same leverage working in reverse. There is no switch you can flip to get the upside leverage without the downside leverage. They come together. Today, gold moved about 3% from its high to its low. Silver moved over 10%. That is roughly a 3 times multiplier. Silver did not get manipulated. Silver did not get attacked by some shadowy force. Silver did what silver always does. It amplified the gold move. The same math that is going to make silver outperform gold by 2 or 3 times on the way up just took it to the woodshed on the way down. That is the deal. If you own silver, you need to make peace with that deal, because days like today are the price of admission for the days when silver rips 15% while gold moves 5%. Now here is where it gets really interesting. Because while COMEX silver was getting destroyed, I pulled up the Shanghai price. Silver on the Shanghai Futures Exchange dropped about $5, from roughly 110 to 104.58. COMEX dropped 10. Shanghai dropped 5. Read that again. The physical market in the East sold off half as much as the paper market in the West. And the gap between the two actually widened during the crash. Right now, as I record this, Shanghai silver is sitting around 104 and change. COMEX is at 88. That is a $16 gap. For the exact same metal, $16. That premium had narrowed over the past few sessions, and now it just blew right back open. What that tells you is the physical market is not participating in this sell-off the way the paper market is. The selling is happening on COMEX, in futures contracts, in paper. The physical silver in Shanghai, the silver that someone actually has to deliver and someone actually has to receive, that silver barely moved by comparison. And when you see a paper market crashing while the physical market holds firm, that is not a breakdown. That is a divergence. And divergences get resolved. They always get resolved. And they get resolved in the direction of the physical market, because at the end of the day, you cannot eat a futures contract. You cannot put a paper derivative into a solar panel. The physical price is the real price. And the physical price is telling you a very different story than what COMEX printed today. Now let me show you the COMEX delivery data, because this is the part that nobody on social media is talking about, and it is the most important data point of the day. I pulled the daily delivery notices for March silver. 306 contracts stood for delivery today. Each contract is 5,000 ounces. That brings the month-to-date total to 4,846 contracts. Do the math. That is 24.23 million ounces of physical silver that has been demanded for delivery in March. 24 million ounces in the first few days of the month. Look at who is issuing and who is stopping. Macquarie issued 151 contracts between their house and customer accounts. HSBC issued 120. Those are the firms putting metal out for delivery. On the receiving side, Bank of America stopped 61 contracts. Citigroup stopped 75. RBC Capital stopped 65, combined between house and customer. These are the firms taking delivery, receiving physical metal into their accounts. Now think about what that means. Silver just crashed over 10%. The price is at $86. And Bank of America is taking delivery of physical silver. Citigroup is taking delivery of physical silver during a crash. They are not selling the panic. They are using the panic to accumulate real metal at a discount. That is not what you do if you think silver is going to keep falling. That is what you do if you think silver is cheap right now and you want to own as much of it as possible before the next move higher. On the gold side, 130 contracts stood for delivery. Month to date, 2,407 contracts, which works out to 240,700 ounces. JP Morgan issued 78 contracts. Bank of America stopped 42. The big banks are actively moving physical metal in both gold and silver during maximum volatility, during a war. While the paper price is crashing, they are not running away from the metal. They are running toward it. Now, let me show you something Bloomberg published today that actually made me laugh out loud. Pull this up on screen. The headline reads, U.S. Treasuries fall as inflation angst eclipses haven buying. I want to break this down because it tells you everything you need to know about where we are in this cycle. U.S. Treasuries fell, bonds went down, in the middle of a war, in the middle of a geopolitical crisis that has the entire world on edge. The thing that your financial advisor has told you your entire life is the ultimate safe haven, U.S. government debt, is going down, not up, down. And Bloomberg's explanation is inflation angst. They are saying the fear of inflation from oil prices surging because the Strait of Hormuz is being shut down is scaring people out of bonds. The 2-year yield rose to 3.44%. The 10-year rose to 3.99. Those yields are rising because people are selling the bonds. European bonds got hit too. Inflation swaps jumped 11 basis points. And the Fed just had its next expected rate cut pushed back to September. Now let me tell you what Bloomberg did not say. They did not say the obvious thing. They did not say that maybe gold has replaced U.S. Treasuries as the safe haven, because that is what just happened. Gold gapped up over $100 at the open. Treasuries fell. Gold is up massively over the last month. Treasuries are down. Money is leaving government paper and flowing into metal. That is not inflation angst. That is a generational shift in where capital goes when the world breaks. For 50 years, the playbook has been crisis happens, buy treasuries. That playbook just stopped working. And Bloomberg is doing backflips trying to explain why treasuries fell during a war without admitting that the answer is gold. Because the moment mainstream financial media admits that gold has replaced treasuries as the real safe haven, the game changes forever. Every pension fund, every sovereign wealth fund, every insurance company portfolio that is stuffed full of government bonds has to start asking a very uncomfortable question. Why am I holding this paper when the market is telling me the safe haven is metal? And here's the part that ties it all together. The Fed is stuck. Rate cut pushed to September. They cannot cut because oil is surging, and cutting into an oil shock means inflation goes nuclear. They cannot hike because hiking into a war economy where the consumer is already being crushed means recession. So they sit. They do nothing. And gold loves nothing. Gold absolutely thrives when the Fed is paralyzed, when every option is a bad option, when there is no policy response that makes things better. That is gold's sweet spot, and we are sitting right in it. And what does Fed paralysis mean for silver specifically? It means the dollar weakens because the market loses confidence that the Fed has any control over the situation. A weaker dollar makes commodities priced in dollars more expensive for everyone else. Silver is priced in dollars. Silver is also consumed by industries that are about to get hammered by inflation. Defense spending is going up. Energy infrastructure spending is going up. Every government on earth is scrambling to secure supply chains. All of that requires industrial metals. And the Fed cannot do anything to slow it down without causing a recession. So the spending continues. The demand continues. The dollar weakens. And silver, which is both a monetary metal and an industrial metal, gets pulled higher from both sides. That is not a trade. That is a structural tailwind that lasts months, possibly years. And a 10% pullback on comics does not change that by even 1%. Okay, let me give you my honest read on where we go from here. No sugarcoating, no hopium, just what I see in the data. Gold at 5,300 after getting rejected at 5,400. That rejection does not scare me. What would scare me is if gold broke below 5,000 and stayed there. That would be a change in character. That would tell me something fundamental shifted. But a rejection at a major resistance level after a $100 gap up is textbook. First attempt. Rejected. Price consolidates. Second attempt breaks. I've seen this pattern more times than I can count. And the setup right now is textbook for a second attempt. Gold is sitting $70 above where it was on Friday. The gap fill did not turn into a collapse. It found a floor at 52.65 and bounced to 5,300 within hours. That is a market that wants to go higher. It just ran into a wall that it was not ready to break on the first try. But every hour that gold holds above 5,200, the base gets stronger. And when the next catalyst hits, and in this environment you do not have to wait long for catalysts, 5,400 gets tested again. And the sellers who already burned through their ammunition defending the first attack will have less to throw at the second one. Silver at 85 to 86. This is the level. I'm going to be completely straight with you. 85 to 86 is the new floor that this entire move needs to hold. Silver is sitting around 88 right now after bouncing off that 86 low. That bounce matters. Think about it. Before all of this started, silver was in the low 70s. The war premium, the supply disruption premium, the Hormuz premium, all of that built a staircase from 70-something up to 96. Silver has now pulled back about half of that move. Half. Not all. The war is still going. Nothing has been resolved. If 85 holds, and I believe it will because the situation on the ground has not improved at all, then this is silver doing what silver does after a parabolic move. It's stretched too far too fast, and it is snapping back to a level where it can build a base before the next leg. That is healthy. That is normal. That is how every major silver bull market in history has played out. Run, pull back, consolidate, run harder. But if 85 breaks on a daily close, I will not lie to you, that opens up the mid-70s. And that would shake out a lot of people who bought in the 90s thinking they were buying a breakout. So 85 is the line I am watching every single hour. Here is what I want you to focus on over the next few days. 1. Does gold come back to test 5,400 again this week? If it does, and it does it fast, the second test usually breaks. 2. Does the Shanghai premium stay at $16? Because if physical silver in the East stays at 105, while COMEX says 88, that divergence is screaming at you. Paper is wrong, physical is right, and that gap will close in the direction of physical. 3. The COMEX delivery pace. 24 million ounces of silver demanded for delivery in the first few days of March. If that pace holds, this could be one of the biggest delivery months in the history of the COMEX silver market. And big delivery months at low prices are the fuel for explosive moves because the metal is leaving the vault. 4. The war. Nothing has changed. Hormuz is still disrupted, Iran is still firing, the fatwa is still active. The Abraham Lincoln is still in the Persian Gulf. Every one of those factors that gapped gold up over $100 is still in play right now. The only thing that changed today is the paper price on COMEX. That is it. Now I want to tell you what would change my mind, because I think this is important. I'm not a perma-bull who screams, buy no matter what. If the data changes, I change. Here is what I am watching. If gold breaks below 5,000 and stays there for more than 2 sessions, not a wick, not a flash crash, a sustained close below 5,000, that would tell me the demand has dried up and something fundamental shifted. If the Shanghai premium disappears, right now Shanghai is $16 above COMEX in silver. If that gap closes by Shanghai coming down to meet COMEX rather than COMEX going up to meet Shanghai, that would tell me the physical market is confirming the paper crash. That would be real if COMEX deliveries collapse. Right now, banks are taking delivery of 24 million ounces. If that number drops to nothing, the institutions have stopped accumulating. That would worry me. If a genuine ceasefire is signed and verified, not a Twitter rumor, an actual agreement where missiles stop and the strait reopens, that removes the war premium. As of right now, none of those things are happening, not one. Gold is at 5,300 after gap fill. Silver is at 88 after bouncing off the 86 low. Shanghai is still at a $16 premium. Banks are still taking delivery. The war is still escalating. And the Fed is still stuck. That is not a breakdown. That is a shakeout. And shakeouts are where the next leg higher gets built. Now, I want to talk to 2 groups of people. First, the people who own silver and watched it go from 96 to 86 today. I know what that feels like. I know the pit in your stomach. $10 in one move is violent. But I need you to ask yourself one question. Did anything about why you own silver change today? Did the war end? Did the strait reopen? Did the physical premium in Shanghai disappear? Did the bank stop taking delivery? Nothing changed. The paper price changed. That is it. And there is a massive difference between the paper price changing and the fundamentals changing. The fundamentals are identical. The only thing that happened is silver did what silver does after a vertical run. It corrected violently, the way silver always does. And if you sell here because the red candle scared you, you are doing exactly what the banks want. You are handing them your metal at 86, while they are actively taking delivery of 24 million ounces this month alone. Second, the people who have been sitting on the sideline asking me, when is the dip? This is the dip. You asked for it. Here it is. Silver went from 96 to 86. Gold went from 5,400 to 5,265. The entry that people beg for in every bull market just showed up on your screen. And I already know what is going to happen. Most of you will not act. You will look at the red candle and say, maybe it goes lower. Maybe it does. Maybe silver touches 83 or 80. And then 6 weeks from now, when silver is back above 100, you will be in my comments saying, I should have bought at 86. I have seen this play out 100 times. The dip shows up and fear wins. Every single time. I'm not telling you what to do. I never do. But I am telling you the dip you asked for is here and the banks are buying it with both hands. Do with that information what you will. I told you in my last video there would be mornings where gold is down $100 and everyone on social media would be screaming that it is over. I told you that exact thing, word for word. And here we are. Gold is down over 100 from its overnight high. Silver is down $10. Social media is on fire. People are calling this the end, and I am telling you the exact same thing I told you in that video. It is not over, not even close. The rejection at 5,400 was the first attempt. The crash in silver was leverage doing what leverage does. The physical market did not break. The banks are taking delivery. The war is still raging. And the next test of 5,400 is coming. When it breaks, and it will break, silver at 86 is going to look like the gift that most people were too scared to take. Drop a comment. Tell me if you think 85 holds for silver. Tell me if gold tests 5,400 again this week. Tell me if you bought the dip or if you are waiting. I want to hear it. Share this video right now. There are people in your life who bought silver in the 90s and they are panicking today because they do not understand what I just showed you. The paper market and the physical market are telling two different stories. Help me reach them before they sell the bottom. If you are new here, go watch the last 3 videos. I called 5,400 as resistance. I called the war escalation. I called the silver volatility. Every one of those calls is on camera. This is the hidden economy. Stay sharp. Stay stacking.